Bank mergers happen constantly, hundreds of them, most years, quietly folding one institution into another. If you've ever gotten a letter saying your bank is now part of a different name, or your familiar branch suddenly has new signage, you've been through one. Here's what almost nobody explains clearly. A merger creates a specific temporary window where your money can genuinely be at risk of losing insurance coverage, not because anything went wrong, but simply because of how deposit insurance math works the moment two banks combine. There's an exact rule that governs this window, an exact length of time it lasts, and specific numbers that determine whether it affects you at all. Let's walk through exactly how this works, using real numbers so you can check your own situation against it. The rule itself, under FDIC regulations, specifically 12 C.F.R. section 330.4, when one FDIC-insured bank's deposits are acquired by another FDIC-insured bank, the newly acquired deposits are treated as separately insured from any deposits a customer already held at the acquiring bank for an initial period of 6 months from the date of the merger. Here's why this rule exists at all. Imagine you already had $200,000 at Bank A. Bank A gets acquired by Bank B, where you happen to already have your own separate $200,000 account. Combined, that's $400,000, or well over the standard $250,000 FDIC insurance limit. Without this rule, $150,000 of your money could become instantly uninsured the moment the merger takes effect, through absolutely no action of your own. The 6-month grace period exists specifically to prevent that instant automatic loss of coverage, giving you time to notice the situation and restructure your accounts before the extra protection expires. Important clarification: if you only had funds at one of the two banks involved in the merger, not both. This rule doesn't apply to you at all because there's no combined balance to worry about. This specifically affects people who happened to bank at both institutions before they merged. Walking through a real example. Here's how the FDIC itself illustrates this, using an actual example worth adapting to your own numbers. Picture a depositor who had a $240,000 CD at Bank A, opened years earlier with a 4-year term. Separately, that same depositor also had a $230,000 CD at Bank B with a 1-year term. On its own, each of those CDs was comfortably insured. $240,000 and $230,000 are both under the $250,000 limit at two completely separate institutions. Then Bank A and Bank B merge. Suddenly, both CDs exist at the same institution. Combined, that's $470,000, nearly double the standard insurance limit. Here's exactly what the 6-month rule does in this situation. For 6 months following the merger date, both CDs remain separately insured, as if the two banks had never combined at all. The depositor has the full 6 months to decide how to handle the situation, potentially moving one CD to a different institution entirely, or restructuring the accounts in a way that keeps everything protected once the grace period ends. Here's where it gets specific. And this is the part that catches people off guard. What happens depends on exactly when each CD matures relative to that 6-month window. If a CD matures after the 6-month grace period ends, it stays separately insured all the way until its own maturity date. Merger essentially doesn't affect it at all, insurance-wise, until it naturally comes due. If a CD matures during the 6-month window and gets renewed for the same term and the same dollar amount, it continues to be separately insured until the next maturity date after the 6-month period ends, essentially carrying the protection forward a bit further. But if a CD matures during that 6-month window and gets renewed on different terms, a different amount, a different length, or if it matures and simply rolls into a regular savings or checking account instead of a new CD, the separate insurance protection ends at the 6-month mark, not at any later date. What else actually changes? Insurance coverage is the part with an actual hard legal deadline, but it's not the only thing that shifts during a merger. Here's what else genuinely happens, in the order you're likely to notice it. Your account terms may not stay identical. The institution taking over has no legal obligation to keep the exact fees, minimum balance requirements, or interest rates you had before. It's genuinely common to see monthly maintenance fees increase, minimum balance thresholds rise, or savings interest rates shift after a merger completes, sometimes for the better, sometimes not. CDs and existing loans are the exception, and this is worth knowing specifically. Rates and terms already locked in on a CD or a fixed-rate loan generally do not change simply because of the merger, though Those contractual terms carry forward as agreed, regardless of who now owns the account. Your account number may change, along with your debit card, checkbook, and online banking login. This is where automatic bill payments and direct deposits genuinely risk falling through the cracks if you're not paying attention to your bank's transition notices. A Social Security direct deposit or an automatic mortgage payment set up under an old account number can bounce if you haven't updated it by the time the transition actually completes. The full transition typically takes months, sometimes closer to a year, from the initial merger announcement to full integration of systems. Most banks build in a grace period before your specific account is affected by any of these changes, and they're generally required to notify you with specific timelines, which is exactly why reading those notices, rather than setting them aside, genuinely matters during this period. The 4 things to actually check. If you've recently been told your bank is merging, being acquired, or is now part of a new name, here's exactly what to check. First, find out if you have any accounts at the other institution involved in the merger. Sometimes, without realizing, 2 separate accounts you hold are about to become one combined relationship. If your combined total across both is over $250,000, that 6-month clock is now running for you specifically. Second, if you have a CD anywhere close to maturing during that 6-month window, note the exact date and understand that how you renew it, same terms versus different terms, directly determines how long your extra insurance protection actually lasts. Third, read every notice your bank sends during this transition, specifically watching for your new account number, new routing number if applicable, and the exact date automatic payments and direct deposits need to be updated by. Fourth, if your account terms do shift, a new fee, a new minimum balance, a lower savings rate, you're not obligated to simply accept it. It's worth comparing what you're now being offered against other banks or credit unions, the same way you would when opening any new account, since you're effectively being handed a new relationship whether you actively chose it or not. A bank merger isn't something to panic about. The FDIC's 6-month rule exists specifically to prevent an instant, unfair loss of coverage the moment 2 banks combine. But that protection has a real, specific expiration date, and the only way to make sure it actually protects you is knowing your own numbers well before that 6 months runs out. If your bank has recently merged, been acquired, or announced a name change, this is worth 10 minutes this week. Check your combined balances, check your CD maturity dates, and read the notices